The one thing that institutions who control vast amounts of the investable capital, probably the majority of investable capital in the world, the one thing that they hate is volatility of return streams. They're fine with exposure to the asset class. They're fine with the beta. They're even fine with the drawdowns. But when you have drawdowns of 80% after a year of up 300% that don't correlate with your index or with your benchmark, that becomes a real problem. And so a lot of funds got scared off in terms of investing large amounts of capital into crypto for directional or beta purposes. We're aiming to change that.
This episode is brought to you by VanEck's Rare Earth and Strategic Metals ETF, ticker REMX. Later in the show, you'll hear about the growing investment opportunity and why these materials are crucial to everything from smartphones to defense. Let's get into it. Before we get started, I want to do a quick disclaimer that nothing we say here is investment advice. As well, nothing we say is marketing or advertising for Monarq Asset Management or any of their funds or strategies. Everything is meant to be informative about the fund management industry. Welcome to Other People's Money. I am joined today by Sam Gaer, CIO of Directional Strategies at Monarq Asset Management. Sam, thank you so much for joining me today.
Thanks, Max. Wonderful to be here.
All right. Well, you've been a trader, a market maker, an executive in TradFi, and now you've been in crypto for 4 years now. You've been involved in some of the most important technological evolutions financial markets have undergone in the last 30 years. We're going to get into all of that. But first, I want to ask you about what's happening in crypto markets right now. It has been quite the few months, really, since October 10th. So what is going on? Help us make sense of it.
So my explanation is actually quite simple. The events that we're seeing today and that we're processing and the market is digesting, if you will, are really this kind of culmination of a perfect storm. 1010, which is, October 10th, October 11th, depending on where the GMT line crossed you. 1010, 1011 was a real seminal event in the industry. We had $20 billion of liquidations, historic downdrafts in marketplaces, liquidity vanishing from order books. The resulting effects have been relatively muted. You really haven't seen a big publicized blow up or some real existential crisis going on like you have in prior crypto drawdowns, right? And that sets it apart because usually there's somebody that you can point to or some firm that you can point to and say, they did it. And really, this was just a culmination of a perfect storm of events, right? That's really started, in my opinion, with some false narratives, and that they're continuing through today. But post 1010, the market, the liquidity on order books on centralized exchanges and decentralized exchanges has been absolutely abysmal. Very difficult to trade in size. Liquidity pockets and liquidity gaps create these air gaps on charts. Just look at any chart right now. And there's this kind of decoupling from macro, which has occurred. You've seen the S&Ps soar and also decline, and crypto just keeps on, just from Bitcoin to ETH to whatever, just keeps on going down, kind of on this downward grind. Some of the false narratives out there were MicroStrategy is going to be forced to sell. It's going to be the end. It's going to be a negative feedback cycle, and it's the end of crypto as we know it, as all of these cycles usually are. And as well as the one that I really got a chuckle out of was BlackRock. So as soon as BlackRock started moving some Bitcoin to wallets and then selling some Bitcoin, if you read Twitter, which I always say, well, if it's on Twitter, it must be true. If you read Twitter, it was like the end. Larry Fink was getting out of Bitcoin, and BlackRock is moving all of their Bitcoin onto exchanges, and they're going to sell it. Well, no, that actually wasn't true. So for people who are not informed, what this means is BlackRock runs ETFs. These are passively managed vehicles. The passively managed vehicles are just that. They're one beta to the market. So there's a mechanism in an ETF called creation and redemption. So when you have a creation, that means that shares are created, and therefore the ETF manager has to go out and buy the underlying asset. When shares are redeemed, that means that the ETF manager has to then take shares back in exchange. They're going to have to sell the underlying asset in the marketplace. And so that was just the mechanics of running an ETF, right? As a result of 1010, there have just been record drawdowns in ETFs, which is concerning. Don't get me wrong, right? That is concerning that you saw after a year of record inflow in about a month, you saw record outflow. So that's concerning. And then I think the final narrative that was out there was the death cross, which is actually what kind of started the 1010. Death cross, death cross. I mean, it sounds like everybody is watching Jim Cramer on CNBC, but a death cross is when the 50-day moving average goes below the 200-day moving average. And that happened a few weeks ago, which started triggering a sell-off in BTC specifically. Of note, we've had 4 death crosses since 2023, and each one of them coincided with a bottoming area. So all of these things kind of came together, and the market sell that you see as a result of all of this. Um, Obviously, it got overextended, and as we got overextended, more narratives started to pop up. More liquidations happened. I think 2 days ago, we had a $2 billion liquidation event as well, which also coincided with the bottom of the market right around 81,000 in BTC.
Zooming out a little bit, coming into the year, obviously we had a lot of enthusiasm with Trump getting elected and looking like the regulatory winds were going to shift. That has certainly happened. And pretty much up until 1010, you would have said, at least with Bitcoin, I mean, certainly some of the altcoins have not had quite the year that Bitcoin had up to that point. Um, but you would say we were following right along with some of the enthusiasm that crypto had. It feels a little different in the past few months, but what do you make of 2025 as a whole?
I love the phrase you use, zooming out. I always use that phrase because you can't judge the performance of Bitcoin, for example, based on a single month or even a single year for that matter. So when you zoom out, and I have this zoomed out right here, just for our little conversation, on a 5-year basis right now, the following assets are the highest performing assets. Bitcoin is up 394%, Solana 306%, gold 134%, and S&P is 87%. You know what's higher than Bitcoin? Ethereum at 439. So if you're looking on a long-term basis, people are trumpeting gold's dominance in the past year. And that's just true in the past year, but over time, not so much. So what we're seeing right now is institutional adoption is soaring. We saw all-time highs as recent as October. And from last year, Bitcoin has been incredibly resilient in its performance. Think about some of the events that would have been existential just several years ago. You had the Bank of Japan unwind. You had German government selling. This is in 2024. German government sold almost all of their Bitcoin right around the BOJ unwind, to compound that. December 2024, Powell comes out and delivers his hawkish comments to essentially put a lid on the market. You had Liberation Day and the events that followed that, and then you had 1010. Any one of these several years ago would have meant a crypto winter. And yet, here we are. As we speak today, Bitcoin's trading about $90,000, certainly off the all-time highs by a significant amount, but certainly to kind of paraphrase one of the articles that I just wrote, and also as a Monty Python fan, we're not dead yet. So what all of these drawdowns have in common is we're still trading in a highly fragmented, very small part of the financial ecosystem that is hypersensitive to sentiment and social networks. So I'm sorry, but I'm just going to give you a recent experience because I was just in West Palm last week at a conference, and on the way down, I'm just sorry, but when I'm on a plane and the 70-year-old guy behind me says to his wife, Bitcoin is at 83, everyone's getting out if they have a brain in their head, probably the clearest buy signal I've ever seen. Akin to when you got into the cab years ago and your cab driver is giving you advice about NASDAQ stocks, right? Um, so like you said, zoom out. If you're an investor, not a trader, right now, Bitcoin is up 400%, as I said, in the past 5 years. gold 134, S&P 87. Never been a better time to own a decentralized fixed supply permissionless asset like Bitcoin. We still have both macro and regulatory tailwinds like never before. I mean, what happened to diamond hands?
With that being said, though, you are a trader and you're a directional trader. You can take both sides. I can tell very clearly that you and Monarch are long-term bulls. Uh, a little bear market is not going to spook you, and you're going to be just as excited to trade it on the way down as you are on the way up. When you have these types of volatile events, what are you doing to mitigate risk and to take advantage of that volatility?
I think it's really important to distinguish between being a trader and being an asset manager or an investor. We happen to straddle both sides of that coin, if you will. Um, so on a long-term basis, we're managing assets. And on a long-term basis, yes, Monarch's house view is we're still bullish for all of the reasons that I've articulated before. But at the same time, that doesn't stop us from trading around our position, which is something you learn on a trading floor, how to trade around your position. Also, importantly, we tend to always, this has been a hallmark of all of my portfolios going back to the VIX days, is I always carry downside protection. Always. So, you never know. Like I used to say, nothing good happens overnight. Nothing good happens on the weekends. Like you always come in for some massive drawdown or some news happening over the weekend, et cetera. You want to be prepared for that. And people might say it's a drag on the portfolio, but I always carry that downside convexity. So Monarch basically at a higher level, zooming out to continue on the theme, basically, we'll take a quantitative view on markets based on a variety of features. So we're at heart a quantitative shop, and our directional fund has essentially elongated our short-term directional signals to fit into a long-term directional expressive view. Um, and as I said, right now, our house view is still long-term bullish. So after we take all our quantitative view, we then construct a portfolio with attractive liquid names that can scale and have positive EV over time. And what do I mean by that? We're constructing an institutional grade portfolio that's going to have top market cap, highly liquid names in it so that we are able to enter and exit position with minimal slippage and scale the portfolio on orders of magnitude without altering construction or return stream, right? Once we select an asset, once we select a position, the next thing we do for every single position is we set what we call a triple barrier risk management fence, which gives us three numbers that all professional traders use in one way or another. We just combine them into what we call a triple barrier. And actually, I learned this term from Marcos Lopez del Prado, who authored some really, really great books on machine learning, advances in financial machine learning. And so I took that triple barrier from that book. And the three numbers are take profit, stop loss, and time horizon. And those are the only three numbers you really need to know in terms of risk management, right? Because what are you doing? You're setting a target price. Here's my expected value. You're setting a stop loss. If my assumptions are falsified, this is where I'm going to essentially exit the position and cut my losses and live to fight another day. And then the third is going to be time horizon. So this is really important, right? Because you can take a view, a short-term view or a long-term view, but define it. Say this is a 1 week tactical event. This is a 6 month narrative, or this is a long-term thematic. And depending on what our quantitative values are, that will feed our assumptions for the triple barrier. And next, what we do is we always want to augment our view with leverage because leverage is highly available and relatively cheap, especially in crypto, given the volatility of the underlying asset. So we want to use leverage either to construct convexity structures, use futures in terms of perps, dated futures, high beta ecosystem plays like some high quality alts that are an ecosystem play on the base token, or crypto linked or adjacent equities and derivatives. Think DATs or think crypto AI equities. So timing is everything here, right? Also, so we war game and plan ahead. So we think about what's going to happen in the future, and then we say if this happens, then we're going to do the following. So if the market is on its highs, like we're trading 124, 125, like we were in October, then I'm going to look to buy some downside convexity because I'm going to protect against the downside. I want to be buying downside when everybody's thinking about upside and vice versa. On corollary, when that gentleman was talking on the plane, I made my decision to roll down all of my upside calls. And instead of having our calls in the 100 to 110 to 120 area, I rolled them down to the 85, 90, 100.
Rare earth metals are the hidden backbone of modern technology and defense, powering everything from smartphones and electric vehicles to fighter jets and wind turbines. Countries around the world are racing to build their own secure supply chains, driving investment momentum. Investors can gain exposure to these critical materials through the Van Eck Rare Earth and Strategic Metals ETF, ticker REMX. Go to vaneck.com/REMXmax to learn more. Now, back to the interview. Will you ever go short?
Of course, we've been as long as 110% long. And recently in this downtrend, because of delta expansion on the downside, we were about 10% short.
That's interesting because you're talking about leverage, and in crypto, the leverage can get pretty extreme. So you're talking about leverage at a position level. It's not that the portfolio itself is getting up to, 5x, 10x levered long, like some of the stuff you see, which is what leads to these liquidation stories that you hear about.
Right. Look, there's nothing inherently wrong with 5x or 10x leverage as long as you have the capital behind it to not get liquidated, right? Or to have your liquidation price set at a level that you're comfortable with. And quite frankly, if you're at a point where your position is getting liquidated, then you have the wrong leverage or not enough capital. Let's put it this way. The liquidation engine on the exchange is not a stop loss engine.
Before we move on to some of the other questions around the business of asset management, again, zooming out, where are we in the 4-year cycle? There's so much talk about the 4-year cycle. The prior peak was in 2021. Here we are in 2025. 4 years later, starting to see negative price action. Obviously, the conversation, is it all over, at least for this cycle, comes up in a lot of people's heads. What do you think?
Well, you may have guessed this by now, Max, but I'm a contrarian by nature. I like to say I built a career out of people underestimating me. So, um, yeah, I think you could argue that the 4-year cycle is intact at this time, meaning that we may have actually seen the top. You could make that argument and you can use data to justify that. And you wouldn't be 100% wrong, right? But time will tell. I'm still cautiously optimistic that this isn't the case. And I'll tell you why. The bull case is intact for owning fixed supply, permissionless, decentralized assets. Institutional adoption remains strong and is continuing to increase. Funding rates and other internals are constructive. We see low levels of open interest, so not even close to anywhere overheating. But at the same time, with all of this negative price action, it's kind of odd that that funding rates are still positive, right? The fear and greed indices that you see all around are all heavily tilted towards fear. So the contrarian in me is saying, okay, I'll take the opposite side of that trade. Structural drivers such as asset tokenization of stocks, bonds, and real estate will continue and push the cycle, I believe, to top in the early to mid 2026. Think late Q1, early Q2. Macro drivers are strong right now. Record deficit that we have shows no sign of abating. Oddly enough, that's a positive for crypto, right? Again, a reason for owning a fixed supply, decentralized, yada yada. And we're about to embark on a Fed easing cycle that was really rekindled this week with talk of the NEC chief in the White House becoming the next Federal Reserve chair. Overall economy is strong. You don't see numbers coming out of the tech sector or the AI sector that are weak, but there are still some worrying signals. So I'm going to balance this a little bit instead of being a raging bull. I'm going to balance this that we're still worried about consumer credit and the level of debt that households are taking on in the United States. we are concerned about the inflation and how some areas of inflation are being managed well, like energy, and while others, like different foodstuffs, are not. And then finally, obviously, what's on a lot of people's minds these days is the AI data center overheatings and as well as overhype. So, and that becoming some sort of contagion, which I think is the largest risk to the upcycle ending, right? Where you have a just a macro equities linked event, or what I call event risk to the downside. So um, overall, still bullish, but cautiously optimistic.
So I want to transition a little bit to talk about Monarch as a business, and I think it would be helpful to tell a little bit of your story and your origins. Crypto hedge funds, crypto asset managers are growing extremely fast. We talked a little bit about that institutional adoption, but part of it is the people that they're bringing over. People like yourself who have just incredible backgrounds and understanding of financial markets from the TradFi space, and whether it's market makers who look at the level of sophistication of the counterparties in crypto and start licking their lips, or people who have technology backgrounds like yourself. I know you've crossed over both sides. It's amazing the talent that these crypto asset managers are drawing in, and it's part of the reason that Monarch is growing so fast. Um, I'd love to just get into your story because you started out in the pits and you were really responsible for the transition of NYMEX from pit trading to electronic trading. And we look at where we are today, where it seems, you watch Ferris Bueller's Day Off, and you see the part where they're going through in the hand signals, and it just seems so far away. When the first time I saw that movie, it seemed like that was still going on.
I'll give a fun fact. So to bring up movies, the movie Trading Places was filmed in the gold pit when I was a runner. And during the summers, I was a runner. I was a teenager, and I know almost every person that they feature in that pit scene. And it's really funny because you can see how people are integrated into it, and you see how the movie is made. And, but I actually used to show that movie to all of my interns until somebody told me that it was like a 1980s movie and it might not be appropriate or politically correct to show these days. So apologies to anybody who ever was offended by that. I started as a runner when I was 15 years old, a summer runner, and I walked into this place, and there were people screaming and yelling and jumping up and down. Just the frenzy and just the raw energy that was there. I said, I've got to do this. And I worked every summer doing that. I clerked, I charted, I answered phones, I managed other runners, and eventually really understood the business quite well. After I graduated, I went straight down to the trading floor. I'm like, I'm not going into banking. I want to do this. I'm young. This is the time to take a risk. Sold my car, bought a seat, built a business, and we were quite successful. I was in copper at the time, then expanded gold, silver, natural gas, etc. And it was an incredible time of life, and it was an incredible time to learn. And the biggest thing I learned there was my word is my bond. You lived by that. It was quite tribal. If you could be the nastiest guy, you can be the most friendly guy. It wouldn't matter. Your personality actually didn't matter. What mattered was at the end of the day, are you a stand-up guy? Did you live up to your word? So did you renege on a trade? Okay, if you reneged on a couple of trades, you would just get naturally selected or transitioned out in that people just wouldn't trade with you. That's just how it was. And you learn that if you got to honor and say what you mean, do what you say. That's it. And so I was always a self-taught technologist as well. I built technology systems while I was in school. And then when I was on the trading floor, I started building technology systems, which eventually morphed into an exchange system. It's kind of modular exchange system. And I left the trading floor and really focused on this towards the end of the 1990s. And by the early 2000s, we had a lot of exchanges as clients. We had exchanges in Chicago, exchanges in Boston, Philadelphia, NASDR, which was the forerunner to FINRA. But the one that I didn't have was NYMEX. And I had become friendly with a gentleman who was the chairman at the time. And I texted him one night on a BlackBerry and said, I have what you need. And this person, well, his name was Vinny Viola, as most people know. And Vinny was in his office. It was 8 o'clock at night. It was post 9/11. So there was a lot going on. And I texted him, I have what you need. He's like, where are you? Come over to my office right now. And I was in my office. And so one thing led to another. And within a couple of months, I had sold my business to NYMEX and they brought me on as the CIO. Once as a CIO, I came into a technology department that was severely dysfunctional. And I got a lot of mentorship from Mr. Viola. He put his arm around me and taught me a lot of lessons, walking around the block by his house, walking around outside by the exchange, a lot about how to run a company, how to lead, how to manage people, and specifically how to make tough decisions. And so tough decisions were made, and I managed the migration from open outcry to electronic trading, which was just, it had manifold challenges, everything from cultural to technology to just systematic in terms of upstream and downstream vendors, as well as rules, legal, regulatory filings, and it was quite the adventure. Let's put it that way. Um, so I after that I was off to while I was at NYMEX. They made me the CEO of NYMEX Europe. I was off to London for a couple of years. I came back after opening up an exchange there, an open outcry exchange that was also a hybrid open outcry electronic exchange. Came back and became the COO slash EVP and helped lead the deal to do not just the IPO, but the eventual $9 billion merger between NYMEX and CME. I took a couple of years where I consulted for various firms, as well as helped Mr. Viola with some of his investments in terms of management and organization. And then the chairman and CEO of FINRA one day called me out of the blue and wanted to have lunch with me. Now, normally this is not a great thing if somebody from FINRA calls you and says we have to talk. But I knew Rick Ketchum from years ago when we were doing the NYMEX CME deal. New York Stock Exchange was in the middle, and I got to meet him, and he's also quite a leader. And at lunch, he basically offered me the CIO role at FINRA, and I came back and I asked Vinny at the time. He and I were running an energy arbitrage desk, and I asked him. I said, "Hey, what do you think about this?" And the reason why I'm bringing this particular thing up is he came up with one of the best lines that I ever heard in my entire life. He said, "Of course you have to go. One, it'll be great for your resume, but more importantly, regulation is the only growth area on Wall Street." So off to FINRA I went for 2 years. It was actually a pretty good overall. I'd rate it as a pretty good experience. 3,000 people in the technology plus other departments that I'd manage. Another area where I needed to right size and right shape an organization that had kind of lost its way, and did a lot of good things there, but eventually realized that being a regulator was not for me and decided to leave. And so I left and I wanted to build a company the way I wanted to build it. Did a little bit of consulting and then built a hedge fund, which eventually became Katana Financial. Set our sights on volatility and being the roll up your sleeves kind of guy that I am, I figured it out and wrote all the technology myself from, order entry to front end to risk management. And in about 2 years, we were one of the dominant players in the VIX market, VIX futures, and traded that for about 7 years. In 2018, in the middle of all of this, I got the crypto bug and we became one of the first market makers on CME in terms of Bitcoin and their new Bitcoin and Ethereum futures. And one thing led to another, and I just got fascinated with it. In 2021, I went pretty much full boat. I gave back money to investors, managed my own capital, and went full boat into crypto, but at the same time, keeping a foot in TradFi, still doing some energy arbs, still doing some VIX arbs, just in case. and called the FTX storm, if you will. I called it about a year ahead of time by just doing some data analysis on some of the fix logs that we had. We were making markets on several different exchanges for several different SMAs. And one thing led to another, and we kind of realized that this was not a good thing. Uh, After that, I spent a couple of years going back and forth between crypto and TradFi. And then in 2024, I decided that I had an aha moment. I took a look at my kids. They're, I'm a little bit older, and I have kids who are in their late 20s and early 20s. And I took a look at them and I said, wow, this is a generation that is really comfortable with virtual currency, really comfortable with virtual payments. They've never known a world without the internet. They've never known a world really without crypto being around in some way, shape, or form. And I said to myself, I'm like, look, this is another one of those instances where my career has been percolated with, which is being at the center or in the middle of a paradigm shift in the industry, right? That's kind of the common thread of all the stuff that I just told you. And I'm like, who's going to make the decisions in the next 5 years? It's this generation. And I said, wow, this is one of those moments. You've got to adapt or die. And I did what I called my Cortez moment, where when Cortez came to the New World, the first order that he gave his men once they came ashore was to burn the boats. And what that signified to them is that there's no way back and that they've got to make it work. So instead of kind of going back and forth between TradFi and crypto, what I decided was I had a Cortez moment. I sold my software and went full on into crypto. I took a job at Block Tower. I had gotten introduced to Matthew and Ari in 2021. And they were, and I was speaking with them. They were looking for somebody to come in and help run the flagship fund. And so I became the co-PM at Block Tower, where I stayed for about a year. And that was subsequently sold to Arca. And in the process, I was introduced to Xiliang from another mutual friend. I'd met the folks at FalconX several years earlier to that. And I was one of the early liquidity providers on that platform. And they introduced me to Xiliang Tang and Monarq, which at the time was called MNNC. And one thing led to another. I came on to Monarq as the CIO of Directional Strategy with a view that we're going to construct a directional strategy or directional hedge fund in an institutional framework.
How much would you say that connections are still important for your ability to really scale up an investment business?
So I look at connections two ways, right? Where you have connections in the institutional world. So that's kind of like the world I was in before crypto. And now I'm in crypto and I'm making institutional connections, but I'm making connections also kind of at the grassroots level. And one thing that I underestimated in 2021 when I kind of jumped in and said, this is for me because Katana, my hedge fund, was a 100% systematic, low latency, high frequency, actually ultra low latency, where we get super excited for finding like 400 micros in a weekend, right? Or 400 nanos, I should say, in a weekend. And I came into crypto thinking, wow, this is all technology. So I don't even have to speak to people. I can just kind of trade, not speak to people. This would be awesome because, why put myself out there if I could just create a machine that does that? I was probably early to AI, but didn't even know it. And it's really funny because crypto, as it turns out, digital assets, as it turns out, is probably more social and more relationship based than any of the other asset classes or industries that I've worked in before. And so how important it is it? It's extraordinarily important. I see the relationships that we at Monarch have, which are on a whole nother level from almost any other business that I've seen in crypto or in the TradFi space. We have relationships between myself, Xiliang, and other members of the management team. We have relationships that span decades. in both TradFi as well as being OGs in crypto. Not myself, but obviously Shiliang, Aisha. And it's fundamental to our business. Relationships are fundamental to our business. It's also fundamental to be able to be referred by folks in the business to people looking for X or Y or Z. And that's what I really love about crypto is that in TradFi, you'd never hear of another fund referring potential LP to you. You would almost never hear that, right? It's so cutthroat, but crypto is a little bit more. Well, people are sharp elbowed and people are really gunning for returns. If somebody can help somebody else, what I've found is that generally they won't ask anything for it. They'll just make the introduction, and if something happens, then that's great.
It's funny that a lot of times you go read like a marketing deck for a TradFi hedge fund. Everything's proprietary. Everything they do is so different than everybody else and so unique. And the secret is that it's not always the case. Do you think that in crypto, like people really do have their niches carved out and it's fine to make a recommendation because what this person is looking for, we don't really do. But I know the guy who does it really well and he's over there.
I don't know if it's everybody has got a niche cut out because our bread and butter has been a market neutral systematic fund, which there are a lot of market neutral systematic funds out there. We just happen to be really, really good at it. But we are in, it's not like we're sharing our secret sauce with somebody, but at the same time, it's not like we're not going to talk to somebody. And so I can't speak to other crypto funds decks because I haven't really seen a lot other than our own. But what I can say is that people are the level of intellect in this business is such that people are uh, okay with themselves and okay with being able to speak to other fund managers. I'm at conferences and people are they're exchanging ideas. They just are. Hey, we're doing this. What are you doing? Oh, what are you seeing with XYZ? Oh, we're seeing this. So I think it's a lot more collaborative than any other part of the financial world.
I guess in many cases, people are leaving like high prestige jobs to come and do something which obviously a lot has changed even since you started to get in 2021, but it kind of gave you a scarlet letter for a certain period of time. It's people talk all the time about the difference between Brits and Americans and the fact that like it's in our DNA that at least some time ago, for many of us, somebody got on a boat and came here to the United States and took that chance. And could say the same thing about crypto where it's in the DNA that people had to go you had to get on the boat.
Yeah, I love that. I actually love that analogy. I'm going to steal that from you. So, but I'll give you attribution. But look, yeah, it is true. Look, I in 2021, I got told that my way, like uh, uh, arbitrage trading or high frequency or knowing X, Y, and Z about technology. That didn't matter because crypto, we do it a different way and it's a new way. And yeah, there are a ton of differences between managing money in crypto and managing money in TradFi. 100%. Absolutely. But what I like to say is like in 2021, the organism rejected me. And I don't know if it was just me or if it was just like people with a lot of experience coming from TradFi in general and kind of impinging on anybody else's turf, if you will. I think all of that changed even before the election, but specifically after the election, it really, really changed to wow, I'm going to conferences and everybody's in a sport coat and a button down, or not everybody, 90%. I still saw guys walking barefoot at Token in Singapore and like, so, but still the maturation of the industry is remarkable in one sense, and I think has just begun in another sense.
Now, what about the types of strategies that you're starting to get institutional interest and adoption in? Obviously, multi-strat, market neutral types of strategies are just eating up so much of assets on the TradFi side. Whereas crypto up to this point has been all about getting exposure, getting that beta and that uncorrelated beta in your portfolio. What has that been like in the shifting demand over the last few years?
So here's the thing, Max. Um, if you would have invested in Bitcoin in $100, $100,000, whatever it is in Bitcoin in 2017, you'd be up about 535%. If you would have invested $100,000 in the same at the same time in a directional hedge fund in crypto in 2017, you'd only be up about 211%, probably less than that, given what the recent drawdown. And so, what is that telling you? What that tells you is that crypto funds, specifically directional funds, have underperformed by at least 50%. I'm being generous. And so, when institutions, we're still very young. This is a very young asset class. Let me preface what I'm about to say with that. When institutions are coming to crypto first, uh, they've started saying, "Hey, listen, I don't really understand what this thing is, but I want the exposure. I can really understand market neutral. I can really understand a stat arb. I can understand that arbitrage. Under this, I can understand, and I can digest it, and I can summarize it for my LPs and for my board." What started to happen with directional funds is because of these 4-year cycles, directional funds would tend to get attracted to alts, and they would invest sometimes in 40 or 50 tokens, and they would hope that most of these would moon. And for the last 2 cycles, that worked. And so you saw directional funds with returns of 3, 4, 500%. And that was awesome. Except for the next year, they were down 80%. And institutions, the one thing that institutions or larger institutions, large capital players who control vast amounts of the investable capital, probably the majority of investable capital in the world, the one thing that they hate is volatility of return streams. They're fine with exposures to the asset class. They're fine with the beta. They're even fine with the drawdowns. But when you have drawdowns of 80%, after a year of up 300% that don't correlate with your index or with your benchmark, that becomes a real problem. And so a lot of funds got scared off in terms of investing large amounts of capital into crypto for directional or beta purposes. We're aiming to change that. So what we're looking at, I kind of took a step back, and what we're looking at is scale. So how do you construct a portfolio that scales and can produce an institutional quality or institutional level of return stream? And I call this the Brevin Howard or 0.72 return stream. And what does that mean? First of all, we need to pick a good benchmark. Everybody has a different benchmark. You know what the benchmark is in crypto? I don't care who you are. You know what your benchmark is? It's Bitcoin. Guys, it's Bitcoin. You're at a party, people are talking about crypto, they're talking about Bitcoin. You're talking to your friends, your neighbors, you're bored. They're always going to compare you to the returns in Bitcoin. Sorry, but that's just how it is. The same way, and we're not alone. This happens in equities. Everybody compares you to the S&Ps. So what happened? Why did people give money to 0.72 points last year? 0.72 was up 19%, which is great, but the S&Ps are up 25%. And if you go on Twitter, even TradFi has Twitter, by the way. If you go on Twitter, you would think that, oh my God, they're underperforming, and how could anybody give them money? Well, when you're an institution, you don't give people money for a year unless they really screw up. When you're an institution, you're looking at money allocated over a decade or more. So if you go back a decade and look at returns, the return streams from large institutional hedge funds, they basically follow the same formula. And that is they offer 80% of the upside of the S&P while trying to limit it to 20% of the downside. So over time, these return streams really compound, and a dollar invested in 0.72 or Bridgewater from 20 years ago is worth way more than a dollar invested in the S&Ps right now. And that's how we're looking to scale and construct our portfolios.
Can the market withstand the amount of capital that wants to get into crypto? It's funny because you're talking about these massive hedge funds. And when you say, oh, they're one of the biggest hedge funds in crypto, the numbers aren't even close in terms of the size. And it's just interesting to me how is that going to grow?
Yes. I mean, look, as I say, we're still young. Let me give you another stat. The market capitalization of all crypto right now is about $3 trillion. The market capitalization of US equities is $70 trillion. During the week of Liberation Day, when Trump declared his tariffs, equities had a temper tantrum and lost 5 trillion in value. In other words, they sneezed and lost $5 trillion worth of value. And so what does that tell you? That tells you that we are an infinitesimally small part of the larger financial ecosystem, but we're also early, which is why I'm really, really excited for the upside. Now, when you look at what's going on with stablecoins, you're talking about a market right now where stable coins at 1.1 trillion are about to become the largest holder of US treasuries in the world. Think about that for a second. From a few years ago, at zero, to now, in less than a decade, stable coins, crypto is the largest holder of US treasury debt. So let's look at gold. Gold's market cap right now is $27 trillion. And people call gold the inflation hedge, the debasement trade, whatever the label is of the week that the media gins up. That's what it is. But gold's market cap is $27 trillion. Bitcoin's market cap today is about $2 trillion. If Bitcoin were to get even less than half, but just let's say Bitcoin gets let's say Bitcoin gets to $10 trillion, you're going to see $500,000 Bitcoin, right? That's just the math. So as the market matures, the pie gets larger. As the pie gets larger, more liquidity comes in, more eyeballs come in, bids and offers decrease, or the spreads between bids and offers decrease, volatility decreases, and you're seeing that happen right now. It's happening before our eyes. Volatility on Bitcoin has decreased from 60% last year to 40% on a good day this year, although right now it's about 50 given the given the drawdown. But overall, you're seeing this market mature. You're seeing flows come in. You're going to continue to see that.
So, what is a big hedge fund going to look like in a few years in crypto?
I think a big hedge fund in crypto is also going to be a big hedge fund in TradFi. You're seeing the convergence happening right now. So I don't think we're going to have that much of a differentiation in terms of specialization, if you will. I think in a very short amount of time, maybe a year, maybe 2 years, every crypto fund is going to be needing to trade equities. And you might be trading equities on chain, but you're going to need to trade equities, crypto linked equities or AI crypto plays. You're going to need to be trading those. And you're going to see the larger hedge funds, Millennium, Bremen Howard, Point 72, are, even though they're kind of putting their toe in the water with this right now, they're going to go all in, because the convergence between the two asset classes is going to mean on-chain clearing and trading of U.S. equities, debt, et cetera. The institutionalization of infrastructure in the crypto industry will be such that you won't be able to tell the difference between a large crypto fund and a large TradFi fund. It's just who really specializes in doing better in what asset.
Is it going to be a two-way street for Monarch? Are you guys getting into TradFi at all?
Oh, we're absolutely. We were early to the DAT trade, digital asset treasury trade. Overall, we, believe it or not, we're still up on that trade, and we've also expanded into crypto linked equities. We brought on two people who are focused on doing that right now. And I mean, from a directional standpoint, it's something I've been very interested in for the past year, specifically cross asset vol between TradFi and crypto. I think is a great trade.
Do you find that on the LP side, that also helps just to open conversations?
Yes. I mean, people want people want you to be able to traverse between both worlds, right? To the extent that they haven't converged yet. To the extent that they have, they like us to be able to speak about, what are you doing with digital asset treasury vehicles? What are you doing with crypto linked equities? What are you doing with IBIT and IBIT options? And it's nice to be able to say, well, we've got a very, very deep background in TradFi, volatility, as well as crypto. So where we see opportunity is where we're going to allocate capital.
So, with all of this opportunity in crypto, there are plenty of great traders out there. What is the difference between somebody who stays a trader, who is managing their own money? Maybe they can raise a little bit of friends and family capital, but they're stuck in the 10 million, $20 million in asset size versus being able to grow into a fund that is starting to take institutional capital and is in the 100 million, 200 million size where you can start to invest in hiring 2 new people to come on and expand into new markets.
Unfortunately, there's no real magic pill or easy process for this. Institutions value a time based track record, they value experience and maturity, and they want to know that you have traded through and navigated from a risk management and a risk adjusted standpoint different market dislocations. From our standpoint, there hasn't been a dislocation since 1998 that one of us has not traded through. And so when we talk to institutions, we kind of have that, Monarch has that sort of gravitas to be able to do that. If you're an individual and you're managing your own money and you're racking up returns, uh, when I was doing that, I'll take you back to when I first formed Katana. It was called Locust Walk Trading, and after Penn, where I went, and I was running my own capital because I knew that that was the way to build the business, and I knew that I had to put my head down and generate returns. And there were months where I was making 100, 200, 300% on my own capital, knowing that even with the amount of capital that I had, any large fund coming in to allocate was going to discount that 100, 200, 300%. Because when you scale that, that 100, 200, 300% becomes 10%, 5%. In TradFi, 5% month in TradFi is awesome. So it's just a matter of time and consistency. Institutions love consistency. So if you can deliver low volatility or high Sharpe, high Sortino returns, and you can do that over time and you can show that you're growing assets, that is the door opener. Unfortunately, the industry as a whole, the financial world as a whole, values size. And so we've kind of morphed into this larger hedge funds attract most of the investments. And so as an emerging manager, you've got to come out and you've got to make your mark, but you've also got to, it's a really hard juggling act, right? Because you've got to deliver outsized market returns, but also have a very smooth return stream.
Between the skills that you got as a trader, you have skills as a technologist, and then you also served as an executive building businesses, dealing with that. When you think about what has led to your success in terms of gathering assets.
I pride myself on being able to go between both worlds. I can sit with any developer in the world and speak to that, look at their code and ask them actual intelligent questions about why things are done certain ways. I can sit with an investor and explain to him why we're making the following investments, why we've allocated capital here, why we made money here, or why we lost money there. And that's really important to be able to straddle those two worlds and be able to speak intelligently to both, right? Because if you don't understand one, you're not going to understand the other. And crypto is extraordinarily steeped in technology. You've really, really got to know not just your tech, but also your trading and the trading tech as well.
How fast is it moving though, the change in technology in crypto? Um, as you said, just a few years ago, people were trading with FTX. Like that's not happening. I just spoke with a crypto manager who said, post FTX, the way that assets are custodied is completely different.
So first, I will make my editorial comment, being somebody who's built exchange technology at some of the largest exchanges and regulators in the world. Um, Improvement in technology, specifically in exchange technology, specifically in the CFI world, is sorely needed. I can't understand the complexity, like why you cannot have a cancel replace order on some exchanges. Why have we not standardized on things like the nomenclature or format for order numbers, or the process for canceling and replacing an order? It's actually pretty simple. And so that's a little frustrating. I guess that's where people make some money. I'm not certain. But certainly after FTX, the focus has been on things like custody. So, things like counterparty risk and concentration. When I was at Block Tower specifically, we were very cognizant of our concentration risk, and we would move capital and even positions off exchanges very, very quickly and put them into a custodian such as Fireblocks Rank. Um, I think table stakes now, in the since the emergence of hyperliquid in particular, table stakes now are uh, decentralized finance having its moment. Finally, a real moment in that hyperliquid really is way out ahead of almost anybody, in my opinion, in terms of offering this centralized exchange experience in a decentralized exchange wrapper. So what's great about Hyperliquid is it's what traders crave. It's what asset managers crave, right? Where it's a really simple mechanism. It's permissionless. You connect your wallet, you're up and trading. You can move capital and you can move collateral in and out very seamlessly and have this great experience from a user perspective and user experience perspective. But you also have some of the deepest order books on the market right now. They've taken 25% of open interest and volume away from the Binances of the world. Their fee structure is incredibly aggressive and favorable to users. And they take, with that reduced fee structure, they still take 99% of what they make in buyback tokens. So owning hype and trading on Hyperliquid becomes an experience that's second to none, in my opinion. And I think that's going to that if that's not table stakes right now, that should be table stakes for the industry. Um, just my opinion, not investment advice.
I guess you're saying you trade on Hyperliquid and you are a big holder of Hyperliquid tokens as well?
Yes, it's one of our core high conviction holdings. But let me just give you a parallel path here. Uh, as a fan of history, right? If you ignore history, you're doomed to repeat it. Well, guess what? We're repeating it. Um, there are parallels to the early days of electronification in both equities and futures back in TradFi, which I lived through. Uh, um, You've got fragmented markets and liquidity. There's no co-location. So this is really important. People think that co-location gives advantages to market makers. Well, it does, but the return for that in equities specifically has been these absolutely compressed, microscopic spreads in terms of bid and ask on major equities. So that's the trade that you make. Larger high frequency firms who provide a lot of liquidity in TradFi are going to demand, if they're not already getting, we don't know, co-location and or favorable fee structures. Latencies right now in crypto are in the milliseconds, not in microseconds or nanoseconds like you see in TradFi. And this is really because there's a resistance to change and consolidation, right? There's a resistance to fee compression or reinvestment. And I think if you follow history, all of this changes in the next 18 to 24 months
Wow.
as we
Okay.
converge with TradFi.
Is it gonna be the usual suspects from TradFi who are gonna come in and take that role, or is it gonna be crypto natives?
You're going to have a mix of both. I think that some of the usual suspects in TradFi, if they do decide to make a really concerted effort, remember, back to the market sizing, we're still very, very small. So this is not yet super interesting, but I know some of the players, the usual suspects, are certainly interested in the space and are looking.
Okay. Do you think they view it at this point as the next thing or as more of a business hedge?
I think right now it's a business hedge, but a serious business hedge. It's still, even with compressed volatility, Bitcoin still has twice the volatility of the S&Ps. Volatility is the name of the game in high frequency trading. The higher the volatility, the more potential profit you make as a market.
How is it affecting the talent that is coming out of, the top universities when you think about the high frequency trading firms and where they go shop around for talent? Are you guys setting foot on MIT's campus and stuff like that? Or are you trying to lure people into crypto directly instead of having them go to the Jane Streets or wherever?
Yeah, look, I'm going to be honest with you. It's very difficult to compete with a Virtue or a Jane Street on campus. It just is. In crypto, you're not going to be throwing packages at people that they do on an entry level basis that you see in TradFi. So we're still not getting, just this is one man's opinion, we're still not getting the cream of the crop. But that's also because, going back to the previous point, we're not profiling in nanoseconds. Nanoseconds don't really matter that much in crypto yet. So as that changes, then yes, you're going to see more and more competition for top level talent.
What else is next for crypto? What are the big trends we haven't touched on yet that you think people need to be paying attention to?
Look, I think we haven't touched on digital asset treasuries, and I can't, I don't understand as a crypto investor how you could ignore those. We were talking about the size of the industry. We were talking about institutions coming into the space, right? And so, what better way to do that than to take down every potential barrier to entering the space? Digital asset treasury vehicles are expanding access to the asset class for people who don't want, can't have, or just don't want to be bothered setting up crypto rails with the complexity of crypto rails, I should say. And so, think about like the dentist in Oklahoma who has a Charles Schwab account and just doesn't want to be bothered with keys and securing his phrases and all the other stuff that goes with owning crypto. But he wants exposure to the asset class. He's attracted to it. He understands it, or at least wants to put his toe in the water. Well, now you go to Charles Schwab, you can buy IBIT. Well, that's passively managed. Well, why not buy something that might be more actively managed in a Bitcoin DAT or an Ethereum DAT that's throwing off some yield and operating as a proper operating company? Now, that all being said, that's
I'm
the problem, right?
Is there concern at all that these digital asset trust companies, treasury companies are going to fall under new regulations?
I don't think so. I don't think, especially given the friendly regulatory environment out of DC right now. I've spoken with both chairs of both regulatory agencies, and they're extraordinarily friendly to crypto, and in a way that is really that would have been alien back in 2012 when I was at FINRA, right? In terms of they are willing to expand what they are accepting. They're willing to expand the range of assets and the range of products that they want to include in this umbrella. And they're willing to say, okay, this is the future. We are going to be friendly to this, and we're not going to regulate by enforcement. We're going to regulate by principle. I don't think that they have to worry about 40 Act designation. These are companies that are operating as treasuries. So what they're doing is they're buying tokens and they're creating and operating. They're actually merging. A lot of these are merging into existing operating entities. So think about a pipe into a biotech. The reality is that they're mostly a treasury vehicle. They have a stash, if you will, of a particular token. And then part of their operating plan is to generate yield from these tokens. So I don't necessarily know that that's a 40 Act designation. I'm not certain that it is. I do know that we have one of the most friendly, if not the most friendly, regulatory environment coming out of DC for crypto that's ever existed. But I think more importantly, if we kind of take it up a level, is the evolution of the digital asset treasury vehicle. I coined a term called DAT 2.0 recently. DAT 1.0 was all about this kind of engineered multiple of NAV or MNAV, where every one of these companies was going out and touting that, oh, because we're a crypto treasury and we're taking crypto and wrapping it in a US equity, we should be getting some multiple to our NAV because of the inherent growth of the asset, et cetera, et cetera. I called MNAV arbitrage bait because that's what it was. And so if your reason for existing is to kind of have this ATM or a registered secondary that's essentially just relying on increases in price to sell shares, to generate cash, to buy more tokens, I think you're on the wrong track. And DAT 2.0, as these companies are evolving now because they have to, because Max, markets go down, right? I'm sorry, but they do. And you're seeing that right now. How these companies are and have to and need to adapt and evolve is into actual proper operating companies. DAT 2.0 is all about, instead of engineering an MNAV, you are increasing the number of tokens per share. That's your mission. That's your reason for being. So you're going to not take all of the money that you raise and blow it on a weekend of just buying the token and now be cash poor. You want to have a cash hoard or what I call dry powder to do as follows. If the stock goes down and people want to sell your stock below the NAV, you will selectively and opportunistically buy your stock back because that becomes an arbitrage to you. So what does that do? Tokens per share. You're decreasing the denominator. Therefore, you're increasing the number of tokens per share. If the market goes up and price allows, use your ATM, sell some more shares, take the cash and buy some more tokens, put some cash aside for your cash hoard. And then at the same time, buy your treasury, your core treasury, buy that opportunistically with your cash. Don't spend all your cash. I heard at a conference from two different DATs last week that they have no cash and that they're trying to raise money to get cash to essentially replenish and sell more, get some cash buy more tokens. And to me, that's just counterintuitive. How do you run a business with no cash? So they evolve into an operating business. Oh, and then at the same time, you now take your tokens and you very strategically stake those tokens and earn a yield. At Monarq, like I said, we were early to this trade, to the DAT trade. We realized this very, very, very early that a lot of companies have inexperienced operating teams, have flawed capital structures like converts and death spiral warrants, which is a term that if you're not in TradFi or not from TradFi, you have no idea what that is. And banks will love to say, "Hey, yeah, don't worry about it. We can always get you more money, and we'll get you an ATM. Absolutely no problem, because that's their business." Well, your business is not that. Your business as a DAT is to operate and return value to shareholders, and that's your primary focus.
So before I let you go, Sam, I just want to ask, what's next for Monarch? Is it directional? Is it multi-strategy? Where are you guys looking to grow?
Look, we're seeing demand for almost all of our products right now, as well as this kind of nascent business of managing DAT treasuries. We're in a really good spot. We're expanding both our assets under management as well as the products offered. Also, I mean, I can't really comment on some of the things that are going on right now, so just stay tuned. But suffice it to say, we're really happy and we're really excited about the directional strategy. To give you, even though I'm not supposed to use numbers, what I will tell you is that even in this market, On the year, our directional strategy is up pretty significantly. And we have weathered the storms of 1010 and this past drawdown by either being up flat to up. And we see no capacity constraints on this particular product.
All right, that's very exciting. Sam, thank you so much. And looking forward to hearing about all the new things coming out of Monarch.
Thank you. Great to be here. Thanks, Max.
Thanks for tuning in. Looking into REMX by VanEck? Head to vaneck.com/REMX Max to learn more.